Good morning, afternoon, or evening, depending on where you're watching this. Welcome back, ladies and gentlemen, for another daily cryptocurrency market update. This is just going to be a short and sweet one, but we're really going to try and cover everything that is going on leading up to the rate decision, and maybe speculating on what we think, or certainly what the markets think. This rate decision will bring. And it's going to be very telling. The rate decision at the moment is currently, I think, 6 hours and 31 minutes away. So it will be slightly less probably by the time you're watching this. It's 85.4% probability that we get a 25 basis point rate hike. Now, we've looked at our 2-year US yield chart, and we've said actually 2 years top, and then they do in the region of a 2.5. That's quite typical. So this is actually well within the realms of possibility. And actually, even though it's another hike, it could be taken as a number of ways. It could be taken as the end of hikes, which markets may get a sigh of relief from. Remember, we want, and we've looked at this in great detail. I don't want to do it because I want this to be a short and sweet video, but my previous videos, it's all on there, and we've been looking at it for a while now. We want rates to go sideways. Rates go sideways typically after the 2-year yield tops. We think that has happened. And when rates go sideways, typically the market does well in that period, leading into a crash that may come on the horizon. So I find myself in a weird position because I'm a bull on the crypto space. You guys know that we took a position back in the cryptocurrency markets at the start of the year after being out of it for the majority of last year. I do think there is still the yield curve to play out. You know, the yield curve is a form of truth. You know, it does predict events. It just doesn't it doesn't say it's going to happen in 6 months. It happens when it happens. The last one was 6 months from the yield curve. The prior ones have been up to 24 months. I think we're in a similar period. I think catastrophe is on the horizon, but I think there's a window of opportunities that people are going to get caught out on where the market is going to do well for a sustained period, leading into a crash. And the crash is likely going to take place when no one expects it. Think back to The Big Short. Are you Michael Burry right now, or are you the banks? And actually, I think most people are Michael Burry right now, but they're wrong. That's a bad analogy. Most people are, expecting the crash to happen now. So they're almost the banks, and it's the Michael Burrys that are saying, actually, completely bad analogy because Michael Burry's known for The Big Short, but that the market's going to go up for a bit before we have this eventual crash. And the reason I bring up Michael Burry is, right now, everyone's looking at this crash. Yes, some people are bullish on the markets, but the majority do still seem bearish, and everyone's expecting disaster. And there's a lot of economic data to suggest that. I just don't think that disaster happens until later on down the line, until the yield curve's likely uninverted, which it's not. We've got this period of time, I think, where the markets are going to do well. And actually, you could even see certain markets go to new all-time highs. Gold is there already. Bitcoin may do it. We're not calling for that. We think 40K plus this year. But ultimately, with this rate decision, these are really important for a number of reasons. We know what's driven the markets, rates. You know, the Fed is the ultimate manipulator of liquidity. Markets are driven from liquidity. It's why we ran up from March 2020 onwards, and now subsequently why we sold off going into 2022. However, these data points for markets are very significant because they kind of give the market an anchorage. You can see a lot of choppiness. I'm not a major fan of Bitcoin's price action, if I'm being blunt. I don't like this kind of skittishness. However, it doesn't look too bad. This structure, and we did previously say this, providing you don't run 26,988-ish, you're looking at continuation. You invalidate this, then we go for our neckline retest, which is still a bullish scenario in my opinion. An unbullish scenario, we've gone through this all, would be if you smash this. So if we get the 25 basis point hike, I think that then it's going to really fall onto what Powell says. If he comes out very hawkish, which he's going to have to do, but if he comes out hawkish and says, okay, we're going to do another, we plan on doing more hikes, then markets might go, ooh. If he comes out and says, because they'll have to readjust for that, if he comes out and says, we'll judge on the landscape ahead, so not guaranteeing or looking for anything, just we'll see how the data unfolds. And if he starts to bring up pressures in the banking sector, so forth, then, that I think would be quite dovish in my opinion. I have a decent expectation of this. I think, yes, it could go both ways. We're in May, sell in May. Everyone's now looking at this and on that trend. And it's kind of like technical analysis. The majority of technical analysis that you get on YouTube is what they want you to get. I have read countless books. I mean, just a few, and I've literally got hundreds on technical analysis. And this stuff worked when only a few people knew about it. But when everybody knows about it, it's you know, it has less of a kind of, there are technical patterns that do play out still, but generally, you know, the kind of mainstream technicals from a trading point of view often fall very short. So we ultimately think 25 is coming. It was very interesting yesterday because this was just like that. And I was sharing this in my Discord. And if anybody wants to join my Discord to find out what I'm doing, where I'm buying, and get more regular updates with me, please do feel free to check the Patreon out. There's a link in the description. Just like that, one day off from the FOMC, a rate decision, the odds of a 25 basis point have been fully priced out. The terminal rate is holding at 5%. This is obviously on Bloomberg Terminal. This kind of move never happens one day out from the Fed meeting. This is the end of cycle type event. Yeah, crazy. This is what I mean by I'm not a fan of the skittish price action that we saw, which is why I'm a little bit, you know, this was I don't like these big sort of moves up. I think there's a far more I think gold and Bitcoin are far more correlated at the moment than the likes of the S&P, although everything's correlated in regards to the liquidity game. S&P slightly up. S&P had a really crap day yesterday. The dollar's getting smashed. The dollar's at a key level as well. You've got this. This is something that I've spoken about previously. And by the way, guys, if you can leave me a like and a comment, it really does help promote this content to a wider audience. You know, you've got this kind of going on. Dollars at this key level here. Bitcoin's at a key level here, 30K. You know, I think that's going to happen, essentially. And I actually think that it's going to be very interesting. Hopefully, I'm free to watch it with the Patreon members later on. The actual rate decision come in. You know, it's at 7 p.m. UK time, for anybody that's wondering. I believe, is that 1, 2 o'clock? Or half 1-ish, 2 o'clock-ish US time. So there's going to be a statement and, of course, the rate decision. And what he says a half an hour later, I think, is going to be very telling. But we'll see how the markets react. They're a little bit skittish at the moment. I've seen a lot of people mentioning the VIX, which I'll take a look at. I've not looked at it this morning, but I will take a look at it with you guys. Yeah. So the VIX, yeah, that's not actually that crazy. And we know what the correlation between the VIX and, of course, the SPY is. So volatility index, high volatility, low point of the VIX, low volatility, high point. So is this going to continue to roll? That's the real question. And we'll see. Today's going to be very, very pivotal. Some sort of more broader economic news. After First Republic rescue, economist predicts further pain with a new era of higher inflation. Yeah, potentially. I think inflation comes down from where it is now, eventually. But I also think that it is going to stay more sticky than it has been previously. And actually, one thing that people aren't paying attention to right now is the election coming up in 2024. Go and look at some of the comments that have been made by the likes of Trump in regards to what he'll do to fight this, opening up oil reserves, drilling, you know, this sort of stuff. This is all stuff you've got to look for moving forwards. Top banking CEO warns of further volatility and predicts more US rescues. Well, you know, Bitcoin and gold have actually been doing quite well under the back end of US rescues. And the reason being is it's speculative, right? It's anti-fiats getting a bid when the fiat system is you know, brought into question, and they're kind of contradictorily adding to their balance sheet whilst trying to tighten. But it's interesting. I want to play this clip from Apollo's CEO, and then I'll love and leave you, talking about what happens in downturns and how things are very liquid on the upside, but on the downside, they're not. We've seen this play out in March 2020. We've seen this play out in 2022. It will play out again. I just think it comes later. I think markets actually have this window of opportunity, and then the crash occurs. This is where fundamentally I differ with many, many analyzers.
10 years, 12 years of easy money forced people to do unnatural things, to look for yield and to look for rate of return. LDI was the first time systemically the question was called. LDI was nothing more than a misplaced expectation on the part of UK institutions that public securities were liquid. They found out they're only liquid on the way up, they're not liquid on the way down. We have that same in certain open-ended mutual funds. We've seen it in ETFs in point of stress. We've seen it even in some private vehicles in point of stress. So this is not a public or private issue. This is a mismatch between the underlying liquidity of assets and the structure of liabilities.
Well, speaking of the public market.
So this will come again. This will dawn again. And this is the problem. You know, if everyone's in the equity market and we've all got one hand in, when it starts, so let's say there's $10,000 in there and there's, 100 of us. When everyone goes to put their hand in to take out because they think risk, the problem is, some people, that are later than others can't quite pull out what they've put in. And this is the kind of cascade. It causes a bit of a cascade. And this will happen again. I just think it happens on later on. Markets could be quite still or even volatile into the FOMC meeting, but we'll see. But really, the yield curve is something that we still pay a lot of attention to, and ultimately think that your crashes usually happen at point of uninversion, and that's what we're expecting now. And you're still at this deep point, and actually look at what the markets do from a point of real inversion. Also look at what happens when the 2-year yields top for markets, and then let me know what you think. All I've got for you in this video, guys. If you enjoyed the content, like as always, appreciate it. So as a comment. I'll catch you all in the next one. Thanks a lot for watching. See you in the next.